Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Jeff Kilburg, Chief Investment Officer with Sanctuary Wealth. We're going to take a look at bank earnings, the volatility in oil, and of course, inflation data. And Jeff, I think the story really here is today what we saw come out of bank earnings. JP Morgan adding to their loan reserves. You have Morgan Stanley investment banking revenue down, not too much of a surprise considering new issuance activity has been really muted for this year, but I think it tells a bigger picture about what the economy could potentially look like in the next couple quarters.
Certainly, Jill, and we are seeing a lot of prudence coming out of JP Morgan, Morgan Stanley as well, but profits missed. In JP Morgan, they anticipated a drop, and it was actually 28% bigger than an expected drop. What's really interesting, and in the initial reaction, I think today, is that loan loss reserve that you talked about. So they're basically attributing about $500 million to that loan loss reserve to prepare, embrace if we do see continued surge in inflation, if we do see a potential pullback or a recession in the economy. But one thing that's interesting is not reflecting the price. I know JP Morgan is down, nearly 5% today, but we forget last year that loan loss reserve, due to the fact that the economy was doing so well, they pulled $3 billion out of that loan loss reserve. So I know this is an initial knee-jerk reaction. This is not the way we wanted the tone of earnings season to be kicked off for Q2, but this is a very prudent approach. And I actually think a lot of the earnings season, a lot of the lower expectations have already been priced in. Not everyone agrees with that view. So I'm cautiously optimistic that you will see some people come in and realize that JP Morgan still has the ability, but we all knew loan origination was going to be dropping. We all knew that auto loan origination was going to be dropping. Did we know it was going to go to 45%? No, but we had an idea that the 10-year was moving from 1.5% to 3.5% because the Fed injected that type of velocity into interest rates.
But what does that say about the consumer going forward? Are there concerns there that we will see an increase in loan delinquencies and bankruptcies? I think that's really what the concern is when you think about the overall macro picture. 2021 is not happening again. We're not getting those valuations assigned. We are not getting all those stimulus checks coming into the system. It feels as if 2021 was an anomaly, almost comparing apples to oranges, but there could be a couple of quarters of concern around the consumer.
Well, to that point, hopefully 2020 never happens again as well,
right?
With the pandemic. But nonetheless, I think the consumer is in a better position than most people attribute. Are there going to be loan losses? Are there going to be delinquencies? Will it be bankruptcy? Yes, that's called rate normalizing. So I think the bankers, their job, they put on their pinstripe suits, and they always really have to be considerate about being cautious and prudent. This is what they do. That's why they're called bankers. They're not traders, not investors. So I think a lot of this bad news or this anticipation of a bad news is priced in. That in conjunction with the surging inflation, the CPI, which I believe is a lagging indicator, Jill, that is the kind of 1-2 punch this season. But I still have high hopes for earnings season. And I really think we're going to see that come out in all the different sectors. But right now, this is initial reaction. And I think it's more of a tone of cautiousness versus profitability.
Yeah, that's an interesting perspective. And we do have to remember we are longer term investors here. Let's talk about volatility in oil prices. We're seeing levels that have not been this low since February. Could that suggest potential alleviation at the pump?
Well, that's one of the biggest inputs in the surge in inflation. We saw CPI come out at 9.1%. That was the fastest pace we've talked about or seen since December of 1981. And that beat expectations on Wednesday by 8. The expectations were 8.8%. So that pain at the pump, that gasoline, that was one of the biggest inputs. We're paying more for food, paying more for energy. So I think that pullback in specifically WTI crude oil futures, that will relieve some pressure. But I think we have to take a step back for a second, Jill, and why I believe we have peak inflation, why I believe peak inflation is now in the rearview mirror. Look at commodities across the whole broad swath. We're seeing lumber down nearly 60%. Natural gas was down about 30%. Crude oil futures, which we just talked about, down 25%. Copper down 25%. So this pullback from the recent highs, I think that's really important. That's where the Fed has the ability to gauge, measure, and be nimble. There's 3 more months of data that come in before that September meeting. I think the July 75 basis points is cooked. They're not going to do 100 basis points. I think the one thing that Fed Chairman Powell has to remember that he can't be going down in history for pushing us into recession. It's an election year, Jill. So I think we have a lot of emotion in the market, but we need to take a deep breath.
On the flip side of commodities, you have the dollar just continuing to head to the upper right of the chart. How could that potentially impact earnings, especially for the multinational conglomerates?
Yeah, you have to think about the S&P 500, right, Joe? 1/3 of their revenue comes from overseas. So that is a consideration. That is problematic. I think it correlates certainly hand in hand as the dollar's become a safe haven, as the Fed has really been forceful in their rhetoric and their action of what they're doing to combat inflation. But let's remember, they were actually the ones that created the inflation. So the misstep of the Federal Reserve was actually the last $2 or $3 trillion in their balance sheet expansion when they moved money supply from 15 trillion in January of 2020 to 21 trillion into November of 2021. But I think the dollar is significantly problematic if we do see continued elevation. At 108, it's somewhat palatable, but you're going to hear a lot of forward guidance from all the earnings season talk about the dollar. And does that potentially ignite some form of currency war? You know, we're not having great diplomatic conversations with China. So do we go back, a decade ago when they were devaluing their currency? Potentially, but I'm not in that camp yet. I think once we kind of get a feeling that I am, my conviction, my view is that we are seeing inflation abate, reverse, however you want to approach it, whatever prism you want to look through. If I'm accurate on that, that's going to allow the Fed to kind of relax a little bit and maybe not take their foot off the brakes, because that's exactly what they've been doing. But the one thing that we have to walk away with, Jill, is that dollar correlation is absolutely correlated to how strong and forceful they're going to be. But let's not forget that the Fed's balance sheet is still $9 trillion. That is the soft pillow on the tarmac.
Yeah, I'm just thinking to myself, I'm laughing behind the scenes here. Currency war. Let's just throw that into the other pillars that the market is nervous about here. I mean, that could really
There's
add
a
some
lot to
volatility.
digest. And I think that's priced in. So you continue to see volatility. I know the VIX is under 30, but at the end of the day, the volatility regime we're in, it's heightened volatility. We knew this going into 2022. The Federal Reserve had the 10-year note pegged, suppressed, whatever you want to call it, 1.5%. This rate normalization process going back decades, and I'm only 47 years old, but I've seen a lot of cycles. This type of process or normalization happens over many quarters, even years. It's happened over months and weeks.
Yep.
So that's the difference. And velocity is a word I use a lot, Jill, when I'm talking to my sanctuary partner firms. Inside of the velocity, you have to embrace it. And there is opportunity. There is dislocation in sectors. There is opportunity we saw this coming as we moved out of growth and into value. So you can't crawl underneath your desk and hide from it, but you have to understand that maybe this earnings season, the way we're kicking off with JP Morgan, maybe they're just a little too concerned what the Fed may do. But I resort to the fact that Fed Chairman Powell, I'm going to invoke the Looney Tune card. I think he's a chicken hawk. I think he goes back to being a dove at some point later in the year.
All right, Jeff, appreciate the insight and experience as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.